Hi viewers, I am Dr. M. Velavan, Faculty, School of Management, Shastra, deemed to be University. Today we are going to discuss about the general principles of life insurance contract. The learning objective of this topic. After discussing this topic, you should be able to understand the fundamental legal aspects of insurance. So before that, understanding how insurance contract work can be very beneficial when you are deciding if you need a lawyer after a car crash or other serious personal injury. There are 7 basic principles applicable to insurance contracts relevant to personal injury and car accident cases. Number 1, utmost good faith. Number 2, insurable interest. Number 3, proximate cause. Number 4, indemnity. Number 5, subrogation. Number 6, contribution. Number 7, loss maximization. Below, we explain each item briefly, including how each may relate to a potential injury lawsuit. These principles are open to interpretation. If you think one of these principles has been breached or your insurance claim has wrongfully been denied, we recommend using our free case evaluation to help decide whether hiring a lawyer makes sense for you. Okay, now we will go to discuss about point number one, the principles of utmost good faith. Okay, both parties involved in an insurance contract, the insured, that means policyholder, and the insurer, that means the company, should act in good faith towards each other. The insurer and the insured must provide clear and concise information regarding the terms and conditions of the contract. This is a very basic and primary principles of insurance contract because the nature of the service is for the insurance company to provide a certain level of security and solidarity to the insured person's life. However, the insurance company must also watch out for anyone looking for a way to scam them into free money. So each party is expected to act in good faith towards each other because insurance contract is basically based on the mutual understanding between the insurer as well as the insurance company. Here both are the insurer must have a good faith about the insurance company. If the insurance company provides you with falsified or mispercent information, then they are liable in situations where this misrepresentation or falsification has caused you loss. If you have misrepresented information regarding subject matter or your own personal history, then the insurance company's liability becomes void. That means revoked. See how a social media post could ruin a personal injury cases. So here you have to know how the social medias are playing regarding the personal insurance policy or car insurance policy. Okay, so social media can ruin your personal injury case. So here we will discuss. You see, every scrolled through your Facebook feed to find someone complained about their day. Okay, it is quite nature. So perhaps you have been seen someone complained about an accident and explained in detail what happened and how it was or was not his or her fault. Okay. Well, they may they made a huge mistake. Sometimes they made a huge mistake. So turns out when you make an insurance claim, they look further into your life than you would think, and your social media presence could made or break your claim. Sometimes the social media presence could make and or break your claim. Okay. Now the insurance companies take hard look at accident claim, but sometimes it will happen. Sometimes the insurance companies are taking hard look at accidental claim. So if you were involved in an accident and make an insurance claim, insurance will look at more than your vehicle. Okay. Just like having an online review to make or break a law firm's reputation, your social media post it important, and it is real life. Okay. It is real life. So insurance companies will do something as simple as a Google search and look into your history and social media presence. Fraud is a common problem when it comes into insurance. It's a common problem, but majority of the persons, they are trying to producing a fake and false information regarding their policy as well as insurance claim. Okay. Many will many will fake injuries or over exaggerate in order to get insurance money. Insurance takes your claim seriously and will look very careful at your history. Many people involved in accidents find that something as simple as a tweet could ruin their claims and deem them the guilty party. The insurance look at sites such as the following social medias are playing a vital role. You see one by one: Facebook, Twitter, LinkedIn, Pinterest, Google, Foursquare, YouTube, Instagram, and Venmo. The last one is and more. Okay, Venmo and more. Okay, so they do not just skim through, but look from the date you claimed an injury and work their way through to the present. Okay, they are not only looking at the time of the accident, but everything you post from the accident until the present. They are not only for looking the accident, they are looking all aspects of your policies as well as information regarding the insurance. Okay. Common mistake after an accident. Usually the people will do, or the companies will do, the following are the common mistake after an accident. Okay. However, mistakes do not only involve saying the wrong thing. Here are some common social media mistakes that would ruin your claim. Number one is vent posting. Vent posting, where you so angry about an accident that you rambled a lot on the internet to let out steam. Okay, were you so angry about an incident that you rambled a lot on the internet to let out steam? Yeah, well, that was a bad idea. Insurance will look at past post, especially those close to the date of your accident. Okay, you do not want to risk insurance seeing that you said something happened that you perhaps left out. Even post from before your accident would be telling. Okay. Did you post a status complaining about a stressful work day 30 minutes before your accident? Something that suggested you were in a bad mood or in an agitated state would cause insurance to be concerned that maybe your foul mood or distracted nature would have played a role in the accident. The second point, posting images. Now I'll ask one question. Did you claim that your leg was injured? Well, then you do not want to post image of you the running and being active the next day. Even if your injury was minor, doing something that would be contrary may not look good. Okay. The third one is locking activities. Even if did not post images or write about activities after an accident, certain websites and apps would ruin your claim. Apps such as Foursquare would pinpoint your location and maybe ruin your claim. They're also playing a lot of role regarding at the time of claiming our insurance. Friends tagged you in a you tagging in photos or at place would also contradict your claim or make it look like you are doing something that you are not. Okay. Maybe your friends posted a picture of a park with a status such as frisbee with friends without an actual image of you playing. This this would still be a red flag for insurance, who will question if frisbee would be possible with the injury you claim. Here you have to think about this one. Okay. Then the fourth point, preparing your online presence after an accident. So is there anything you can do after an accident to make sure your claim cannot be deemed fraudulent? So you have to think about it, because is there anything you can do after an accident to make sure your claim cannot be deemed fraudulent? So follow these steps here. Okay. The number one, Google yourself. Since your insurance company is going to do it, you should beat them to the punch and see what they would see. Okay. Maybe pictures of you drinking show up. Even if they are not from the time of your accident, think of the image you want to present of yourself. You do not want insurance to label you as a heavy drinker or as a person who violent behavior. The second one is delete incriminating post. Delete incriminating post. Anything that could image your insurance claim, your insurance claim should be deleted right away. That status, that complaint about your significant other just asked before the accident, and that photo of you playing basketball the next day. Think to yourself what looks bad and would ruin my claim. Okay. Anything that presents you in a negative light should be deleted. Third one is be careful what you post. This is very, very, very important. At the time of feeding our information, we have to be very careful whether it is correct or not, whether it is safety or not. So we have to think and give input regarding our insurance claim. Okay. It is essential during this time to be careful of what you say. Okay. Anything slightly fishy could ruin your claim. Okay. Even if you think it is something safe like going out for so and so's birthday, okay, it could actually be seen differently by whoever is looking into your history, okay. Why would the victim be going out if they broke their leg? Would not that be difficult, okay. The fourth one is watch what your friends post. This is very important. You have to watch and you have to monitor what your friends post, okay. Even what people post about you would be the thing that ruin your claim, okay. If a friend tags you in an image that looks bad, you may not delete in it, I mean it in time, okay. Tell the people you hang out with not to post anything about you so that you do not risk insurance catching something before you are able to delete it or remove yourself, okay. Then fifth one is increase privacy settings. Increase privacy settings. Although it may not be 100% foolproof, okay. Boosting your privacy setting would be helpful, but majority of the cases it may not be 100% foolproof. Boosting your privacy settings would be helpful, okay. Also, do not accept random friend request because it could be someone looking into your social media history, because some people are always looking into your social media history. So you have to be very careful here, okay. The second principles of the general insurance, I mean life insurance contract, is the principles of insurable interest, okay. Insurable interest just means that the subject matter of the contract must provide some financial gain by existing for the insured or policyholder and would lead to a financial loss if damaged, destroyed, stolen, or lost, okay. The insured must have an insurable interest in the subject matter of the insurance contract. The owner of the subject is said to have an insurable interest until he is no longer the owner. The first one is the insured must be an insurable interest in the subject matter of the insurance contract. The owner of the subject is said to have an insurable interest until he is no longer the owner, okay. In auto insurance, this will most times be a no brainer, but it does lead to issues when the person driving a vehicle does not own it, okay. For instance, if a person who is not on the insurance policy of the vehicle hits you, do you file a claim with the owner's insurance company or the driver's insurance company? For instance, if a person who is not on the insurance policy of the vehicle hits you, do you file a claim with the insurance company or the driver's insurance company? So this is a simple but a crucial element for an insurance contract to exist, okay. Now we will see the third point, the principle of indemnity. So indemnity is a guarantee to restore the insured to the position he or she was in before the uncertain incident that caused a loss for the insured. The indemnity is a guarantee to restore the insured to the position he or she was in before the uncertain incident that caused a loss for the insured, okay. Second one is the insurer, I mean the provider, policy provider, compensate the insured compensate the insured, that is the policy holder. So the company can compensate something to the policy holder. The insurance company promises to compensate the policyholder for the amount of the loss up to the amount agreed upon in the contract. Essentially, this is the part of the contract that matters the most for the insurance policyholder, because this is the part of the contract that says she or he has the right to be compensated, or in other words indemnified for his or her loss. Okay, the amount of compensation is in direct proportion with the insured losses. Generally, the amount of compensation is in direct proportion with the insured losses. The insurance company will pay up to the amount of the insured loss or the insured amount agreed on in the contract, whichever is less. So the insurance company will pay up to the amount of the insured loss or the insured amount agreed on in the contract, whichever is less. So this is the way of payment of insurance money to the policyholder. But here they have to take the whichever is lower of the above two figure. Okay, for instance, you see one example here. For instance, if your car is insured for rupees 10,000 but the damage are only 3,000, you will get only 3,000, not the full amount, because the insurance is based on the damage and value of loss, the value of loss. So this is very important, but usually the insured value is very important. Usually the damage value compared to the insured value. So when the insured value is damage value is less than the compared value, the damage value will be given to you. When the damage value is exceed the insured value, here they will apply the average class. The proportionate value will be given to the policy holders. Okay, compensation is not paid when the incident that caused the loss does not happen during the time allotted in the contract or from the specific agreed upon causes of loss. As you will see the principles of proximate cause. Okay, we will discuss later this point in detail. Okay, the insurance contract are created slowly as a means to provide protection from unexpected events, not as a means to make a profit from a loss. Okay, this is by I mean it's a protection from unexpected event. So here we have a safeguard. We have to prevent our loss, and we have to safeguard our future. And also we need some support from the insurance company at the time of accident happening. Okay, but it's not make profit from a loss. Okay, just it's a compensation. Therefore, the insured is protected from losses by the principles of indemnity, but though stipulations that keep him or her from being able to scam and make a profit. Okay, I hope all of you understand regarding the point number 3. Okay, now we'll go to the fourth point, the principles of contribution. Okay, contribution establishes a corollary among all the insurance contract involved in an accident or with the same subject. Contribution allows for the insured to claim indemnity to the extent of actual loss from all the insurance contract involved in his or her claim. Okay. For instance, imagine that you have taken out 2 insurance contract on your used Lambo Rigni, so that you are covered fully in any situation. Let us say you have a policy with Allstate that covers rupees 30,000. In property damage and a policy with State Farm that cover 50,000 in property damage. Okay. But your policy insurable value is 30,000, but the damage value is 50,000. So if you end up in a breach that causes 50,000 worth of damage to your vehicle, so then about rupees 19,000 will be covered by Allstate and rupees 31,000 by a State Farm. So this is the principles of contribution. Okay, each policy you have on the same subject matter pays the proportion of the loss insurance by the policyholder. Already I told you, when the insured, damage value of loss exceed the policy value, here the damage, the claim will be given only on the proportionate manner. Okay, in proportionate manner, it is also called the application of average class. Okay, it is an extension of the principle of indemnity that allows proportional responsibility for all insurance coverage on the same subject matter. Okay. Now we will see point number 5, the principles of subrogation. This principle can be a little confusing, but the example should help make it clear. Okay. Subrogation is substituting one creditor, the insurance company, for another insurance company representing the person responsible for the loss. Okay, so it is just like substituting, others will take care of this accident. That's all. So one insurance company substituting another company to take care of this policy. This is called subrogation. Okay. Here you see this point. After the insured, policyholder, has been compensated for the incurred loss on a piece of property that was insured, the rights of ownership of this property go to the insurer. So once again you see, after the insured has been compensated for the insured loss on a piece of property that was insured, the rights of ownership of this property go to the insurer. So let us say you are in a car wreck caused by a third party and your file a claim with your insurance company to pay for the damage on your car and your medical expenses. Your insurance company will assume ownership of your car and medical expenses. In order to step in any file, a file and file a claim or a lawsuit with a person who is actually responsible for the accident. That is the person who should have paid for your losses. Okay. The insurance company can only benefit from subrogation by winning back the money it paid to its policyholder and the cost of acquiring this money. Anything paid extra from the third party, it is given to the policyholder. But in general, anything paid by extra by the from the third party, it is given to the policyholder. Okay. So let us say your insurance company filed a lawsuit with the negligent third party after the insurance company had already compensated you for the full amount of your damages. Okay. If their lawsuit ends up winning more money from the negligent, the third party, than they paid you, they will use that to cover court cost and the remaining balance will go to you. Okay. I hope all of you understand problem number 5. Now you see problem number, point number 6. The principles of proximate cause. Okay. The loss of insured property can be caused by more than one incident, even in succession to each other. Okay. Property may be insured against some but not all causes of loss. When your property is not insured against all causes, the nearest cause is to be found out. If the proximate cause is one in which the property is insured against, then the insurer must pay compensation. If it is not a cause the property is insured against, then the insurer does not have to pay. Okay. When buying your insurance policies, you will most likely go through a process where you select which instance you and your property will be covered for and which ones they will not. Okay. This is where you are selecting which proximate costs are covered. If you end up in an accident, then the proximate cause will have to be investigated. You have to be investigated so that the insurance company validates that you are covered for the incident. This can lead to dispute when you have suffered an incident you thought was covered, but your insurance provider says it is not. Okay. Insurance companies want to make sure they are protecting themselves, but sometimes they can use this to get out of being liable for a situation. This might be a dispute where you will need a lawyer to help argue for you. So this is point number 6. Now we'll go to the point number 7, the principle of loss minimization. The principles of loss minimization. This is our final principles that create an insurance contract, and the most simple one probably. Compared to other one, it is very simple. In an uncertain event, it is the insured responsibility to take all precautions to minimize the loss on the insured property. In an uncertain event, it is the insured responsibility to take all precautions to minimize the loss on the insured property. The insurance contract should not be about getting free stuff every time something bad happens. Therefore, a little responsibility is bestowed upon the insured to take all measurable measures possible to minimize the loss on the property. So this is very, very important. So both the insurer as well as insurance company will try to minimize the loss on the property. Okay. I hope all of you understand all about all the principles of the insurance contract. This principle can be debatable. So call a lawyer if you think you are being unfairly judged under these principles. Okay. Now we are going to discuss about the regulations on life insurance investments. In the interest of the protection of the policy holder, the most important matter connected here to is the investment management of insurance companies. It has become a challenge in the present day scenario with the convergence of financial situations. The challenges is more seen in the areas of financial management, which in fact determine the success of the insurance companies. Globally, insurance companies are the most regulated for the only reason that they deal with the public funds. Basically, insurance operations really on the trust of policyholders. Hence, insurance companies' investments are subject to serve regulatory framework mainly to safeguard the interest of the policy holders. In India, in India, the investment guidelines are issued by the IRDA in the present paradigm followed the opening up of the insurance sector. The aggregate investment activities of any country's life and health insurance industry are a major source of infrastructure capital for the national economic growth. They are the major purchasers of government securities. Assets or investment are classified according to the nature of the liabilities for which the assets are held and invested. Some assets are used to support contractual obligations for guaranteed fixed benefit payments normally held in general account. Assets held to support other liabilities associated with investment risk are held in special accounts called separate accounts. Example, valuable annuities, pension product, variable life insurance, etc. Now you see importance of investment performance. The investment performance of an insurance company affects profits, dividend, interest credit on terms, etc. Preference of specified assets held for specified liabilities affects variables, life and annuity products and pension funds when benefits by contract depend upon investment results that are passed directly to contract holders. Moreover, the prices of insurance product are dependent on investment returns and insured earns. Insurer that earn about average return can price product favorably to retain customers in a competitive market. Investment management is a process involving asset liability management, integration of investment management and product design management. For favorable pricing, other important economic constraints include inflation, monetary and fiscal policy of government, investment market opportunities, insurers market share, competition, tax liabilities, etc. The regulatory constraints, rating agencies' views, brokers, agent, currency rates, trade balances, and geographic location of liabilities are also to be considered in setting investment policy by international insurers. Further, the investment policy of the life insurance establishes a level of risk tolerances for individual assets as well as for mismatched assets and liabilities. Hence, the primary objectives of an investment policy should be to create an investment portfolio with cash flows that matches an insurance expected liabilities, cash flows and asset liability risk management strategy, and striking a balance between solvency and profitability. Trade-off in investment decisions necessarily involves understanding the central concept of investment risk and to acknowledge the relationship of investment risk and expected return. Greater the degree of risk associated with investment imply greater are the expected returns. The objectives of investment portfolio management is to maximize investment return for a given level of risk or minimize. Risk for desired level of return. The level of risk or minimize risk for a desired level of return. Full stop. Investment risk can be defined as the potential variability of return. The trade-off in two areas requires social portfolio management consideration than other investors. The insurance pricing risk is one special area which takes into account the rate of return to calculate premium. It is also used to discount the price of the insurance to policy owner. The discounting practice has two important implications, namely the asset liability matching systematic risk in the second consideration, special to financial intermediaries. The changing market interest can affect the value of company's asset and liability, and also the behavior of its customers. Okay, like other investors, the life insurance also prefer higher return to minimize the cost of insurance products and to maximize profitability. Keeping in mind the idea of investment margin or spreads. Now we are going to discuss about the rules of life insurance contract construction. Life and health insurance policies are typically written using standard forms containing much technical language. The applicant does not have any opportunity to negotiate modifications in the policy. This Athenian nature led judicial authorities to adopt special rules of insurance contract construction that favor the policy owner. The three common classes of contract constructions rules are: number one, doctrine of contra profundum; number two, doctrine of good faith and fair dealing; third one is reasonable expectations doctrine. Number one, doctrine of contra profundum. Okay, any ambiguities in contract language is construed strictly in favor of the insured. This is called doctrine of contra profundum. Okay, the second one is doctrine of good faith and fair dealing. Here, each party to the contract is to avoid impairing the rights of the other. The duty requires insurers to make a prompt and full settlement with the insured and beneficiaries and to consider the insured interest in setting claims. Third point is reasonable expectations doctrine. The marketing patterns and general practices of an insurer will be honored. So here the marketing patterns and general practices of an insurer will be honored. Some other rules are there. So now we will discuss one by one. The fourth rule is presumption of death and disappearances. When a person leaves his usual place of residence and is neither heard of nor known to be living for a term of 7 years, the person is presumed to be dead. Therefore, if number one, an insured disappears for a period of 7 years and two, the absence is unexplained, the insurance company may be required to pay their policy death proceeds. This issue usually involves around the second of the two conditions. Okay. Then fifth point is insuring agreement. The insuring clause contains the company's promise to pay benefits. It may also describe the types of losses that the policy will cover, or it may simply tie the promises to all of the terms and limitations of the policy. Okay. The last one is the sixth point, insures liability for delay, improper rejection or failure to act. Okay, insurance liability for delay, improper rejection or failure to act. Okay, failure to act. So many courts have held that when an insurance retain an applicant's premium but has not issued the insurance policy, elementary justice dictates that the contract of insurance is in existence, or else the company is liable for damages caused because of its delay for failure to insure. Okay. The law as it is pertain to the agent. As it is pertain to the agent. Okay. So now we are going to discuss about the legal provisions pertaining to an insurance agent. Okay. Life and health insurance companies worldwide really an agent for product sales and customers advice. An agent is the legal representative of the insurer. I think they are called broker is the insured legal representative. This misalignment may occur because the incentives that motivate the agent usually differ from those that motivate the principals. This may lead to principal agent problem. To avoid this problem, an entire body of laws has evolved that attempt to establish clear rules of authority and contact in connection with this relationship. Okay. First, we will discuss power of the agent. The following are the power of the agent. Number one, actual or express. Number two, implied. Number three, apparent or perceived. Okay. The actual or express. The granted to an agent by the principal in specific language or terms. It may involve wide or general authority, or it may be limited to a narrow field or even to a specific act. Okay. Then implied one, second one, implied is that associated with certain duties such as the cashier's authority to take payment for merchandise at a checkout counter. The third one is perceived or apparent is when a third person believes the agent possesses the authority because of circumstances made possible by the principal and upon which the third party is justified in relying. This authority is based on the principles of established. The principle will be prohibited, established from declining later that no agency existed. Okay, engaged to perform. So, dear students, today we have covered the general principles regarding the insurance contract and also we discussed the rules of life insurance contract construction and finally we discussed the legal provisions pertaining to an agent. Okay, so I hope all of you have understand without any doubt. Okay, so thank you very much for